My bearish video in February saw the divergence between the transportation ETF XTN and the S&P ETF. This bearish divergence surfaced in April in the form of tariffs and the S&P dropping 19% into bear territory. Intrendias found this bearish signal early, so click subscribe to get video updates like this. The SPY has been flat going into 2025 with AI spending concerns and tariff scares. Simultaneously, we see the transportation ETF decline since the peak in December 2024. This could signal some downside for the S&P in the short term. Now we are here today, and where might the stock market go from here? Both SPY and XTN seem to have found support around 500 and 320 respectively, with the potential for a recovery in the short term. VIX is a measure of market volatility, and this sharp increase in the VIX suggests the market is in panic, coinciding with the S&P dropping. But previously, we have seen the S&P's ability to recover from these sharp volatility increases. In February 2022, Russia invades Ukraine, sending oil and commodity prices higher along with volatility. In March 2022, we saw the Fed hike interest rates, and when suggesting the rates would be higher for longer, the VIX jumps. In June, inflation numbers were hot at 9%, causing major economic health concerns, potential slowdowns, and recession risks. So, in short, in 2022, we had inflation plus Fed hikes plus Russia starting the war, recession fears leading to spikes in the VIX. However, we could argue that these VIX spikes were good entry points, especially for long-term investors. When the market is suppressed and sentiment is negative, any sign of relief will be pumped back into the stock price. Same with 2024, election year, sticky inflation, and higher for longer rates, and the Middle East formed VIX spikes. But there was strong technicals, and these drawdowns served as good long-term entries. But now with 2025, we're basically flat for the year, and the VIX massively spiked over 50 because of tariff uncertainty. We are seeing a breakdown in the technicals as the SMA 50 slices through the 128 and 200 lines. But how fast can the economy landscape be resolved? The tariff approach eased for most countries down to a baseline of 10%, but the relation with China is heating up. The previous tariff rate of 34% ballooned to 145%. This would increase costs onto the consumer as logistic pipelines need to be updated, considering Apple and India. Raw material costs increase, and these costs are pasted onto the customer. The tariffs are being used as a negotiation tactic. The market increased when the rates were updated to 10% because this seems to be a more calculated, predictable approach, and the stock market likes predictability. Besides tariffs, there are other economic pain points. We had the inverted yield curve, decline in consumer sentiment, and inflation since COVID stimulus money flooded the supply. But perhaps we can look at historic situations to forecast the future. Like in 2025, the US was experiencing a strong bull market in 1998, prior to correction from the Russian financial crisis and the LTCM failure, causing a global risk-off sentiment. The correction in 2025 may be tariffs and stock overvaluation after a strong bull market. Of course, these 2 years are not the same, but an interesting starting point for analysis. We can see the VIX pass 30 and peak to 45 in 1998, causing a dip in the markets. The technicals broke with the SMA 50 below both 128 and 200 like today. However, we eventually saw stability. The S&P got support around 900 and continued upward as the dot-com boom was just beginning. We can overlay both the S&P 500 from July 1998 and January 2025. We can see a resembling stock price pattern. Both years experienced a shock. Russia defaulted on its debt on August 17, 1998. Trump's Liberation Day tariffs was on April 2nd. Both events shocked global markets. 1998 continued to experience turbulence with the crisis of LTCM causing massive sell offs and a Fed intervention. In 2025, we could see continued turbulence similar to the W market pattern experienced in 1998. For aggressive option traders, a put option may be beneficial for the next 30 days to capture on the double bottom pattern if it emerges. For long term investors, investors may want to wait for the second bottom to appear as an entry point. Plus, we have had a bullish signal on the breadth thrust, a technical indicator with strong track record since 1950, posting a buy signal on April 24th, 2025. We have a large earnings week coming up starting on April 28th, which can be a good source of turbulence to make the double bottom pattern come true. Also, the advance estimate for U.S. gross domestic product GDP numbers come out Wednesday, April 30th as well, adding to the volatility mix. With the pre existing negative sentiment in the market, it could be argued that a negative GDP reading is already priced in, but how bad is the economy? We will find out soon enough. I could probably just dollar cost average into BRKB and not worry about any of this.